Rate cuts are not a tool for growth. Rate cuts tend to be the manifestation of a very weak economy. But in this particular case, it is exceedingly important to remember that the Federal Reserve is cutting rates when financial conditions are at the loosest level seen in more than 2 years. Not just that, but at loose levels compared to history. Furthermore, the rate cut comes when the Federal Reserve sees, and I quote, no reason for a recession or a downturn. Hence, the big problem of this rate cut is that something does not add up. If the Federal Reserve does not see a problem in the labor market and a problem in the economy, and certainly the level of inflation remains persistent with services inflation and shelter above 5%, what we need to be is at least aware of the fact that it may be a very significant risk that the Fed is simply allowing the government to increase even more its deficit and its debt and to bail out the public finances in a way that is very dangerous, because when governments receive this incentive to take more debt, they do. Not just that, but the problem is that the cost of debt remains very elevated. It's now above $1 trillion, and even if there's a rate cut, and even if there's a path of rate cuts as markets expect, it'll continue to rise because the deficit spending is simply out of control. All those things have to be taken into account because they mean lower growth, less job creation, and certainly lower real wages in the future.